Welcome back to the channel. I hope you're having a great day wherever you are around this beautiful planet of ours. Today's video, macro overview as we prepare for the two biggest announcements left for 2022, barring any sort of black swan event. We'll get into that in this video, plus look at the volatility index that has just spiked over 10%. We've also got the S&P to go through, the US dollar continuing the collapse. This has been something that's going on for many, many months. Let's see what happens here. And of course, what's going on with poor old little BTC. So if you haven't already, smash up that like button, subscribe to the channel. If you want to wait to see what the value is in the video, by all means, I'll remind you again at the end of the video. But normally, I like to hit that like button first up so I don't forget. So what we're not going to forget is the two announcements coming out this week, the major ones happening. The first one happening within less than 12 hours, the CPI here and the core CPI. And then if we go through to Thursday morning our time, but of course Wednesday afternoon US time, we have the federal funds rate also coming up, which is currently expected to be 4.5%, which is basically a 0.5% increase. And so with this increase and the extra news announcements coming in this week, we've also seen the volatility index spike. So we've gone up nearly 10% in the last 24 hours. Typically, when the index goes up, we tend to go down in the S&P. You can see what happened last time this occurred with the volatility jumping. That was the 22nd of August. We had a sharp drop off on the S&P as well. That led into this low in October. So people are naturally wondering whether this is just another bear market rally and we get another crash further down, which is something that we've covered in yesterday's video. So I'll leave those links at the end of this particular video that you can go and watch right here. But for now, volatility has spiked. People are expecting lower prices. We're going to cover what we think is going to happen with this particular interest rate announcement. And what we've seen here as well is the largest daily percent increase in the VIX. So along with the volatility spiking, which typically leads to further downside, what we're seeing on the S&P is a potential trading range forming. Well, there is actually a trading range here, looking arguably at around 4,200 points, which are the peaks here in June and then again in August, and then the lows heading around 3,600 points, June, September, and October, with a few days just spiking underneath in October to form our current cycle low. So naturally, everyone is wondering whether we are going to continue down. But as we covered in yesterday's video, which I'll leave a link to at the end of this video, you can go and watch that for more detail. We've got plenty of support levels on the way down, 3,800 points, 3,700 points, and then our 3,600 point level. So even if we get that move down, this could just be volatility decreasing in the overall macro picture. So volatility is obviously on the rise, but when we scroll out on a more macro time frame here, what normally happens is the market or the VIX indicator typically drops to about 11, so 10 to 12 on the reading here. So I've got a line here at 11. That's when we tend to see those big volatility spikes. You can see it happen again 2017. We had a spike into 2018. We got very close here at the peaks of late 2019, early 2020. You can see in November 2019, just at around the high 11 mark, which then spiked really, really hard into the 80s. And so right now we're kind of trending up, as you can see with the pattern here in the volatility, but overall we haven't reached any of these lower levels to put in any sort of massive volatility spike. Over the history of the volatility index, you can see that we are beginning to form some consolidation here. So the volatility overall is getting less and less over time until we reach probably somewhere between the 11 and 16 reading before we can go on another big spike. As for the interest rates, the market is anticipating a 0.5% rate hike. As we can see here, with 73% expecting the target rate to go up to 4.5%, with only 26% expecting the 75% rate hike. Moving forward into February, which I find quite interesting, the target rate is set at about 5%. So we're currently at 4%. Should we get the 0.5% this time round, then in February, the market is anticipating another 0.5% rate hike, with the possibility of it only being a 25% rate hike. But what gets even more interesting is the further we go on in the year, the more stable the interest rate seems to be. You can see that the market is expecting it to remain around 5%, maybe slowdown here into 5.25%. As we go on into May and June, you can see that the market is anticipating pretty steady interest rate of around 5 to 5.25. Go through to June after May, same sort of deal here, 5 to 5.25%. That's where the highest numbers are so far. And we step it out all the way to the end of next year. So 12 months time from now, the market is anticipating that we may go up to 5.25, and then pull back to about 4.5 to 5% again. And so this could all be good news and potentially being factored in to the stock market already, which is potentially why we may have a cycle low in October. This is the current cycle low. This is the October low right now at around 3,500 points. Remember, this market can still go down. I'm not expecting it to remain exactly at 4,000 and only ever go up from this point. I do expect pullbacks along the way, but I'm not anticipating, based on the data that we're seeing, any sort of major collapse to numbers a lot further down, going back to potentially the COVID crash low at 2,700 points, which is what a lot of people are expecting now. But what we could see leading into that first quarter is some sort of move down around the lows, testing these levels, maybe 3,500, maybe 36 or 3,700. Either way, there generally is a test of the lows. So even though we could get some higher prices after this announcement, I do anticipate in quarter one that we come back and test the lows if that doesn't happen right now. Essentially, that could look like any sort of pattern on a chart. The main thing, the easiest thing to understand is, provided we remain in this range here and not go too far below the 3,500 points, that is still a bullish sign, even if we remain under this bearish downtrend. Just holding in this zone is a good space for the market to consolidate before trying higher prices. And this is all going to have an effect on Bitcoin and cryptocurrencies leading into that next stage of the cycle through 2023, 2024, 2025. But we need to start seeing even more stability in the S&P in the short and medium term in order to get through to that next stage of the cycle. As for US inflation, the market has been coming down. 9.1% in June was the peak, and ever since that point, we have had lower and lower inflation. Core inflation also peaked last month as well. That was September, so 2 months ago now. We had the October data at 6.3, and there is expectation of possibly something similar or slightly lower for the November figures. So this is all going to be positive news for the market. If it remains at the consensus or slightly lower, that's going to be good news, and we could see those moves up, which could then force a short squeeze on the S&P and start to push us that little bit higher from this point. Now, continuing with the overview here, because we have covered a hell of a lot on the channel over the last few months, so make sure you are subscribed to the channel, checking out these videos as they're coming out almost daily here. And of course, like the content up, the US dollar has been the big one here. So back in September, we looked at September being a top, a significant top for this cycle. And so far, this has played out to a T, all the way down now for coming up to 3 months to the downside. We've had 10 weeks down, and eventually we do need to get some sort of reversal going on here. And you can see the market is really trying to just put in any sort of gains it can, holding above the previous support level of 104.5. And if it can do that, I think it's going to be short-lived and potentially further downside to the US dollar. The US dollar coming down is actually a good thing for the markets. It helps out international trade a lot. You can start to see commodity prices coming down, and you can see in previous cycles as well, as the US dollar started to fall, the market is able to start to trade again with other countries around the world, which helps international trade. What tends to happen with the US dollar leading into the second half of the real estate cycle, something that we've covered here on the channel as well, is that the dollar tends to spike at the end of the first half. And what we're leading into now, which isn't covered almost anywhere else on the internet, is leading down in the US dollar value as we head towards the peak of the next half of the cycle, the second half of the real estate and an economic cycle. So this is a good thing for the cycle to continue. Now, of course, it can take months. Maybe we hold out here and start to work our way down over the coming years. Maybe it's only a slight decrease into the 90s again. But either way, a weakening US dollar is going to help the second half of the real estate cycle. Recently, we also looked at the midterm election year and what happens the third year of the presidential cycle as well. And so in the last 21 bear market cycles, 12 of them bottomed in a midterm year. And 2022 was a midterm year. We just had those elections in November. And the crazy thing about 6 of these bottoms is that they bottomed between June and October: 1962, 1966, 74, 82, 1990, 2002. And if you look at the S&P, we had a bottom in June and another bottom in October. So it's pretty crazy to see that the amount of data here over the last 21 bear cycles going back 60 years, it's almost happened to a T. You have a first bottom, a second bottom, and what we can see in some cases is a third bottom, but potentially higher. And we remember in the case of 2002, we had that higher bottom forming into that quarter one, which is why I typically continue to talk about a coming low for the S&P. Hopefully it's a higher low. Either way, provided it doesn't go too much further and remains within the support zone, this is going to be a fantastic setup for the second half of the cycle. And so far, everything has been on point. So where does that leave little old Bitcoin? Well, not much has changed since yesterday's video. We're still waiting on the market to get back above 17.6, which is an absolute key level, as it was the low set in June. So it's really struggling to get back above that. Volume is decreasing as well. So we're not going to be too surprised if we see the market test some lower prices. And if that lines up with what's happening on the S&P now, should we get a little bit of a breakdown at some point over December, January, February, this might also work pretty well with that test of the lows so that Bitcoin can finally recover and get back above the 17.6. Potentially a little bit of hopium in there, but right now a lot of the timing cycles have come out for Bitcoin, meaning that the time is basically up. We had the big FTX scandal in November and the market dropped the least amount. Pay particular attention to that. Although it was an extreme case, a lot of people lost money, a lot of people are still struggling in their portfolios. The move down is potentially the final capitulation for this market. Should we see it drop just a touch further, this is really starting to wear out on the market. Just look at the chart yourself. You can see the moves down were very extreme, very volatile, and they've become less and less and less over time with bigger and bigger news. This is a sign of markets bottoming. That's a look at how I'm interpreting the data and what I'm expecting over the coming days, weeks, and months. As an investor of over 16 years and 6 years in cryptocurrency, of course, everyone is encouraged to do their own research and act on their own plans. So check out this video, use it as a reference source, like, subscribe, check out the videos that are popping up on your left-hand side right now, and hopefully I'll see you back here at the next video. Until then, take care and peace out.